Father's Day was Sunday, but we're taking the opportunity to talk to very well-known investors on what their philosophy is on investing, what is the kind of message they're passing down to their kids, and what would they put in their portfolio if they wanted to build a portfolio for their kids. So we're talking wisdom and wealth, and our next speaker is Samir Arora. Of course, we talked to him about what's happening in the markets right now as well. He's founder of Helios Capital, and he's had this conversation with our colleague Alex. Listen in.
I do want to ask you about some intergenerational portfolio building strategies that you might be able to talk about. But before we get to that, and it's a start of the week where there's so much that is happening globally, so it would be wrong of me not to ask you about those things first. So let's get that out of the way, and then we'll get to advice. So you've seen everything that's happened over the weekend, crude oil prices since Friday going up. How much attention are you paying to that latest conflagration on geopolitics?
So the thing is that recent experience in terms of Ukraine, Russia war, and many other wars that have gone, including India, Pakistan, that right now the assumption is that, these wars last for a short period, although of course the Ukraine war is still going on. And therefore, I think the markets have, beyond falling of 1% here or there, have shrugged it, and so have I, on this hope that even Israel is saying that, this can last 10 days, and US says that I will try and resolve it after a few days. So there's no point in panicking now and then coming back 5 days later saying, okay, it is over. So let's now hope for the best that the response of Iran is there, but it doesn't look that it is going to really blow up into a multi-country war and all that. So for now, we actually do ignore it.
Okay, so you're looking through it. But crude oil prices, they've been soft and hovering near that $65 per barrel mark for Brent. Talking about Brent, they've moved very suddenly up to 75. And I was looking at the RBI's projection or assumption as they talk about it for the inflation projection, it stands at $70, which is not too far away from that 75. Yeah. So from that perspective, even that's not too much of a concern. But what would cause you to worry if crude oil prices go to 80 or thereabouts?
No, not crude. I think if US gets directly involved, because the war, that's what I'm saying, it all depends on the response of the Iranian. Because if that response is sort of more aggressive, going into other countries, going into the places where US has forces, trying to stop the flow through that, the Hormuz Straits or whatever, all that is more serious and will require, or maybe not require, but will automatically lead to a more significant response from US. And then that makes it more serious. Right now, let's hope that the Iranians are also, in some sense, actually, they are doing it in a disciplined way by not trying to involve US in it, because maybe they know that they can't handle a US response. So whatever it be, right now we'll have to see as it goes. And nothing is forever in these things, but for now, let's just
those are some words that I didn't expect to hear, the way that you're describing Iran, but let's move on from that.
The point is, 3 days later, they'll say, this has been resolved and oil has fallen $10. Yeah. So what's the point? Let's just see whether it really looks something worth bothering about.
Let's see where it settles. So then let me ask you this. We've seen intermittent flows into Indian capital markets, and of course, not whole hog buying, right? And I'm talking about foreign institutional flows here. Do you see that holding off just a tad bit while there's so much uncertainty, and what are the implications for India's market?
It might be in the short term, but again, that's what I'm saying. In every aspect, you'll have to ignore the next few days, 5-10 days. But in general, the outflow from US is very, very significant because the inflows into US since 2008 have been very, very significant. So the amount that the foreign investors have in US versus what the US investors have in non-US markets, that difference right now, something like $20 trillion. And this has happened because the US market has done very well since 2008-9, and the rest of the world has done poorly. And you can see it also from the weightage of US in the MSCI World Index, which used to be in the 50s, and now is something like 65, 67, something like that. So that it is clear that the world does not want to have this higher weight, including us. We have a global fund in which up to Jan end we had maybe 74-75% in US. Then we raised cash and now we have not gone back fully, but our plan would be to have only 50% in US. So that's a big difference. And I'm just one small example. And it's not only me, you can see it in flows, you can see it in ex-US world indexed ETFs have started raising a lot of money. This was an article either in Bloomberg or Wall Street Journal, because these are the only two primarily I read along with FT. But basically the article was that these ETFs, which are ex-US world index trackers, have suddenly started getting lots of flow. So many people are thinking like me, it's not that I'm the only one. But these flows, if they go into non-US, then because the proportion is, let's say 65 US currently and 35 non-US, and you move a few percent from US to non-US, then every half decent country will get some flows, and India is beyond that. So India should get proportionate to its size, reasonable flows. Another thing is, we really beyond a point don't need their flows right now. We first need to stop their outflows. So if that is there, and then a little bit of a flow is also there, and then the Indian guys have their own money.
On that point, do you think that the treasury yields as they stand right now is something that will cause them eventually to move? Or
that is part of the story. That's all part of the story why people are buying gold. Even we in our new weightages want 9 to 10% just plain gold in it rather than having zero gold. And we have already got 6%. And otherwise, personally, I own a lot of gold for the last 2-3 years. Not only me, now you saw there was an FT report, I think this weekend only, that the sovereign, not sovereign funds, basically the central banks, second largest weight after US dollar has become gold and has crossed euros. Of course, partly because of appreciation of gold, but also because they bought, I think, 100 tons per year or something for 3 consecutive years or something. So that is also clear. And it's all an anti-US, anti-dollar, anti-their deficit, anti-their issues. And also the fact that it was too much it had become on its own, not that somebody actively overweighted it maybe, but that the index rates became very high because of their continued outperformance for whatever, 15, 20 years.
Okay. Samir, focusing specifically on Indian equities and the valuation earnings story, do you think that it's comfortable right now? What is your base case assumption? Has that changed after you saw the 50 basis point cut? Because obviously, it'll take a couple of quarters for that to flow through.
Correct. So it is not that you can have a runaway rally. Our first idea is that you should stop falling because of flows, but you can't have a 20% rally because of flows. So I would think that in the next 9-12 months, if you can be up 10%, it'll be great. And then by that time, hopefully some earnings improve on consumer side, maybe on IT side. And it's not only being driven by financials and some very select sectors. So right now, we are not saying it's some massive run, but it can be held well. And you need periods of this consolidation, you want to call it or whatever you call it, but basically it's not a one-way thing, even if there are flows from everywhere.